But that is kind of a one key thing to watch for any of us that are involved in markets or, follow the prices of assets we own. So that is a key thing to watch. Elsewhere, there's a lot less debt in the system. And so it could go a lot further before it would run into problems. Whereas now the feedback loop is a lot tighter. And so it runs into issues sooner. So yeah, ever since 2014, roughly coincided with the end of QE3, quantitative easing 3, the third round after the global financial crisis. When that ended, we had a pretty strong dollar surge. And although it's fluctuated, it goes up to say at 100 on the dollar index. It's gotten as high as like 114. It's gotten down. So it goes through these kind of waves in this period. But during that 11-year stretch, it's all been pretty elevated. And we look at it on a trade balance basis, it's very strong. When you look at its effects on, what type of assets are doing well, what types of economies are booming or not booming, it's all characteristic of a stronger dollar environment. Generally, when you get a truly weaker dollar move, you'll get something like an emerging markets boom for maybe 3 to 5 years. You'll get probably a round of inflation. You'll probably get a round of kind of value stock outperformance. We've not really seen any of that at scale. Sometimes you have individual years of that happening. For example, 2017 was a good kind of rotation year for those types of assets. This year so far has been somewhat of a rotation year, but these are kind of smaller moves compared to what you can get when you have a true, say,
I can only imagine that on a much bigger scale. And living through that, I haven't built a house in another country before. And then you just start thinking, man, how inevitable is something like Bitcoin? Because how can the world work like this? It's madness that people have to deal with that all the time.
Yeah, we built a home in Egypt. We went through similar issues over the past 2 years. And it's also, even when you're just in a country with high inflation, for example, in Egypt, they're dealing with something like 25% annual money supply growth in that country. And so imagine all contracts in that country, whether it's wage contracts, whether it's supplier contracts, all those things have to kind of adjust on a regular basis or someone's getting really messed up. And it adds a overhead problem to every entity trying to do business in the country and every worker.
Yeah, and I didn't really think about it at this level, but what it also does is it makes all of those vendors become speculators, because they're all now trying to speculate on what the price changes will be on those currencies. So I didn't really understand why at the gas stations there's one price for Mexican pesos and one price for dollars. And it's well, because they can't go exchange those dollars maybe till the end of the week, and then we don't know what the exchange rates are going to be, so they have to make up for that in
Europe and East Asia and places like that. And I do think it's bigger than just trade, because a point that I've been making a lot is that the current issues with U.S. trade specifically are heavily tied to the global monetary system as it's structured. So go back to my point that every several decades, these things tend to change pretty substantially. This is potentially more than just a trade cycle. Part of why so many entities even talking about a monetary change or a change in structure is because it's so tied to trade. And a point that I've made is that basically the other side of being the global reserve currency is something in your economy is generally getting hollowed out. There's some sort of imbalance that's kind of embedded into the system, and you're kind of paying this cost to maintain the privilege of being the global reserve currency. So back in the Bretton Woods era, the cost was that we were draining our gold reserves. We had pegged the dollar to gold. A bunch of other currencies pegged themselves to the dollar. And then the dollar was the primary global funding currency. So the combination of fractional reserve banks and deficit spending made it so that the number of dollars kept increasing dramatically, but our gold reserves were not. And so over time, as you get more foreign redemptions, our gold reserves fell from 20,000 tons to 9,000 tons, and then they quickly defaulted on the ability to redeem dollars for gold. And intentional system as designed. And two, there's usually real politics at some point that hits. There's national security interests that hit. And so, for example, when a pandemic hits and they're like, wait a second, we can't make ventilators.
Yeah.
Why can't we make ventilators? Or semiconductors are super important. Why are all the semiconductors being made in Taiwan and South Korea, for example? That becomes an issue. So people usually don't lose sleep over where shirts are made, but they do lose sleep over where complex machinery is made, especially if it's a handful of kind of places in the world. So, and there's a weird things you don't think about, like pharmaceutical components, medical dyes that are needed in imaging. just little widgets here and there that our industry is just heavily reliant on. And if you do have some sort of trade embargo, you can have a national security issue and kind of shortages and things like that.
As we saw in 2020, to your point. And I'm bullish on tariffs for the most part, and I agree with you. They're strategic. They're not blanket. We're not trying to grow coconuts in the U.S., right? We want to import those types of things. And also, tariffs also work for protecting certain industries, especially allowing industries to grow. So, for example, bringing back some of these competitive things like microchips, for example, and doing some tariffs might make it more cost beneficial here. Also, in the U.S., we've sort of shot ourselves in the foot by doing a lot of environmental regulations against rare earth elements or certain minerals that we might need here, and bringing those things back just by loosening some of those political, I guess if you would call them those political regulations.
The administration, the Stephen Myrons, and then you have the other faction. So I think that's one of the challenges, is kind of seeing which side's winning at any given time. There was a similar dynamic in his prior term, but that was more of an establishment versus anti-establishment contingent. Whereas this term he put together, this administration's more, it's more fully anti-establishment, but then there's still different factions within that.
Yeah. I guess what I was asking about is maybe some fundamental transformation of the system, getting away from the dollar being that reserve currency that's always forced to then export its manufacturing sector. So there's been hints, I mean, Luke Grumman talks about quite often, but hints about, revaluing gold, for example. Obviously, there's a strategic Bitcoin reserve bill put forth. And so maybe doing something to sort of get away from that pure fiat, U.S. Treasury dollar system and going back to something like a gold or a Bitcoin. Is that what you're talking about?
Well, yeah, that's what I mean by factions. So, for example, in Stephen Meyer's paper, he talked about how if what he's saying is basically ends up happening, it'd be beneficial for gold and cryptocurrencies, which would primarily be Bitcoin. He used the phrase cryptocurrencies, but basically gold and Bitcoin would benefit from this more neutral reserve asset type of system and a more multipolar system. Then you see a little bit of pushback from within the Bitcoin.
Right.
And that's where you could have different factions, because you could have, there's literally the Myron faction potentially talking about adding a fee to owning U.S. assets, and then another faction saying, how can we get more entities outside of the U.S. to own U.S. assets via stablecoins? Right. So there's a little bit of a potential conflict there. Also, one of the things that Myron proposed was trying to get foreign holders to term out their debt. So basically to say hold fewer T-bills and 2-year T-notes and things like that, and how to get them to buy potentially newly issued 50-year bonds or century bonds, for example. Whereas stablecoins need the opposite. They generally need pretty short-term collateral, or you're potentially risking a pretty big mismatch of assets versus liabilities. Right. And so if anything, I mean, that increases the appetite for T-bills and maybe potentially other fairly short-term treasuries. It's not functionally that much different than reserve holdings. It's kind of the money of the people rather than money of the central banks. We do see kind of a gradual top-down slight de-dollarization, whereas you don't see that on the bottom up. Generally, when you go to the black market in Cairo looking for money, it's the dollar. It's not it's less so the euro, less so the Chinese yuan. Even though China is the biggest trading partner with Egypt compared to the U.S., it's still dollars that are desired. And so there is a lot of bottom-up demand for stable coins, and by extension, T-bills, and surpluses, and current account surpluses. So they have a huge stockpile of sovereign assets and private assets. And so as we saw, for example, a couple years ago when their currency was weakening sharply, they can sell treasuries, so they can sell dollars to backstop their currency, potentially break short attempts. So they have a lot of ammo to really draw this out, and potentially have, for example, make the Fed go back to QE because of potential dislocations in the treasury market before they would run into a true crisis. We've seen some comparisons between Japan and Greece that came up in the news lately. Right. That Japan debt to GDP is now higher than Greece's was at the high point. But a key difference is, one, Japan is incredibly productive compared to Greece. They have a much more diverse, productive economy. And two, the debt is in their own currency, whereas Greece was subject to a currency that they didn't fully or even have substantial control over, whereas Japan does. And so they have a lot of different levers that they can pull to keep the wheels on the track for a lot longer, I think, than people expect.
So you said it's sort of on a different cycle. So like it's saying, like it's showing the same thing. It's the same fundamental thing as most of these developed countries, but it's further ahead. A lot of times people would say that Japan is 20 years ahead of us. So it's like, we'll get there. Maybe the UK or Australia or Canada.
It's very mathematically implausible that anyone's going to be successful in that. And as we've seen, there's been pretty abrupt pivots, and even the people that said they would now kind of backtracking. On the other hand, it means that they're going to keep the wheels on enough. And I think that's true for the US. I think that's true for Japan, where it's also not going to spiral to some crisis in the next year, 2, 3 years and stop in that way either. I think it's basically going to run hot for any sort of investing time horizon. When we're looking out 2 decades, that's a whole different world, right? I'm not trying to make 2-decade predictions, but I'm trying to look 5, 10 years ahead. And basically that in that time frame, there's relatively low scenario probabilities for how we're going to do anything other than run hot for that period.
So would you say that given, debt to GDPs of the US 120, Japan, what are they at, 240? I mean, so huge debt to GDP ratios, giant deficit spending percentages and dollar amounts on that as well. And to your point about them being able to keep the train on the track, then almost like any recession that we would have in the future would almost be a policy decision?
In a way, yes. Another way of putting it is that emerging market recessions and developed market recessions look different. So, for example, in an emerging market, you often won't get an unemployment. With generally, the only exceptions were like you'll see a 12-month period during recession where briefly fiscal deficits are bigger and lending has contracted. But now in this kind of period of fiscal dominance, even when we're not in a recession, fiscal deficits are usually bigger than bank lending. And so this is kind of this more background running hot. And so it's actually pretty hard to have the type of recession we've come to expect. But that doesn't mean you can't have periods of economic weakness or people kind of correctly feeling that they're worse off than they were the year before.
Yeah. And so I guess what you're saying is, since we typically see money supply go down, banks aren't lending as much, so the money supply is not as expanding through debt creation. But now that fiscal dominance, government spending has eclipsed that, whatever the banks are doing from tightening and loosening their lending regulations doesn't affect it as much as it did, because now we have this fiscal dominance.
Yeah, it still affects part of the economy. Like, it affects small businesses that are either getting or not getting that credit, and on what terms. But for example, the fact that Social Security checks are still going out, and Medicare spending still happening, and huge defense spending still happening, and interest expense is still happening. Those are different vehicles where this money's pouring into the economy. And so generally consumption stays pretty strong, for example. And so the net result is that the thing runs hot compared to what you'd normally. UK gilt crisis in 2022 was an issue. At the same time, the US Treasury market didn't break the way that the UK's did, but ours became wobbly. Like, we had like record high move index, like meaning Treasury volatility. Over that year and then the next year, the Treasury Department shifted toward kind of an unprecedented issuance of T-bills as a ratio of their debt, which they normally only do in crises and recessions. But despite the fact that there was no official crisis or recession, they were shifting more and more toward T-bills rather than issue as much as they generally should have been doing on the longer end. And so that was kind of a softening of the Treasury kind of offsetting some of the Fed tightening. And then in early 2023, when the banks ran into issues, they blinked, and so they gave liquidity provisions, and soon after they slowed down and then stopped interest rate increases. So they kind of ran into the guardrails that they could do, and so some of these background forces, like the big ongoing fiscal deficit, despite being profitable every year for like a century, and the reason they do that is because why would you not issue 30-year bonds at 2% if you can? It's basically financial arbitrage. Right. And so that's been the name of the game. These big successful blue chip companies, they take out debt they don't need because they can and it's cheap, and they basically shorten the currency for 30 years at 2%, which is great. Yeah. They're buying back shares, they're paying dividends. So Bitcoin introduces another thing you can do, which is hold a scarce asset on your balance sheet. So you're protecting yourself from debasement, but you're also not turning your whole balance sheet into liabilities and basically decapitalizing yourself as much as possible. When capital is not, kind of respected, all these companies said, well, we don't want capital then. And so this is a new tool to actually have capital. The other strategy, I think, on top of that is arbitrage, which is if this currency is going to keep weakening, we're then going to try to issue debt in that currency and buy this way better currency. You see this to some extent whenever you have like an emerging market currency crisis. There are companies there that say, well, we could take out bank loans in our failing domestic currency and buy dollars with it. That seems like a good trade. And then sometimes you'll see, for example, like this is happening.
Products, so MSTR, STRK, STRF, sort of like financial products that they're bringing to market, almost like maybe like an ETF. And then I think of it like, well, I mean, I guess the market could bear thousands of financial products. So maybe it's not as bubble-esque as some people think it is right now, or do you think it's sort of hitting that level?
I don't think it's too bubblicious yet. I think it goes through periods of micro bubbles. I tend to, when MicroStrategy is hitting like over 3 times NAV and every single person on Twitter is talking about it, that's when it tends to get temporarily overdone. And then it goes through a period of consolidation. The market digests that move and then potentially sets up a new round higher in the coming months. There is somewhat of a network effect here. So liquidity really matters. And having a liquid option market really matters. So MicroStrategy is kind of in a unique position where their equity is very liquid, their options market is very liquid, and so that is a pretty self-sustaining network. It's
like, subscribe, and turn on notifications. Support the channel by liking this video, subscribing, and enabling post notifications for more content on crypto and digital assets. Check out our other videos and share your thoughts in the comments below. Your engagement helps with the YouTube algorithm and keeps the content coming. Thanks for your support. Enjoy the video.